Hello everyone, this is Sundaram Mutual Fixed Income Outlook. Let's start with a little bit of background first. Last month began on a negative note. As you know, in budget, there were two surprises thrown to the market. First was higher than expected gross borrowing number and higher than expected fiscal deficit number. But was soon followed by a dovish monetary policy, uh, uh, which helped in soothing the rates. But finally, when the global commodity prices, including the oil price, in reaction to the geopolitical risks which were increasing towards the month end, the market reacted by pushing up the yields towards 6.89, the highest closing during the month. By month end, the yield saw closing of 6.77 as RBI reacted by cancelling the weekly government bond auctions. That provided some relief. The 10-year benchmark yield remained volatile from 6.66 to 6.89 and closed at around 6.77. Crude prices, which were all along going up, saw a high of $39 per barrel, which is a 14-year high, very near to the all-time high. And this is along with the sharp uptick in a lot of commodity prices, including fertilizer and even some food items like cooking oils, etc. Before we formulate a view on rates, there are a couple of points in monetary policy, last monetary policy, and the minutes of it released later, which we have to keep in mind. First, that on growth and monetary policy, the number forecasted for FY23 is 7.8%, lower than the market expectation and lower than the economic survey's projection of 8.5%. In that projection, we saw the Q2 growth has been moderated by RBI to 7% by around. This is down by around 80 bips from this last projection in the last policy. Q3 and Q4 growth are expected to go down to 4.3 and 4.5. And along with this low growth numbers, there is also a bigger surprise in form of lower than expected, lower than market expectation inflation numbers. For FY23, RBI projects 4.5% CPI number, headline inflation number, which, if you break down between quarters, witnesses third quarter inflation number, third quarter FY23 inflation number at 4%, which is the RBI target, and fourth quarter number at around 4.5. So that is much lower than what market is expecting. So basically, RBI is projecting a lower growth and a low inflation environment, which gives it a space in this kind of scenario to focus more on growth rather than inflation. Because as we know, our GDP has just crossed the pre-pandemic levels by the quarter end of the last quarter of FY21. So there's a lot of gap to be covered. So till now, the central bank in India has been focusing on growth, and looks like with these kind of projections which are there, that there is no reason with the current stance. There is no reason that which can push central bank to change its stance or give a rate hike faster than what markets are, what it has indicated in last couple of policies. But things are developing now, and as we have seen, Russia and Ukraine war crisis has meant that many commodity prices are near all-time high and all-time crossed that also in many cases. So that will mean that in coming days, the inflation projection will have to be updated by market participants and definitely by RBI also. And also, this has given rise to stagflation kind of scenario in future. It may have pushed this current last policy has changed expectation of market, and definitely it has pushed the normalization of rates by at least a quarter or two ahead. However, if this current flare up of prices which is there right now doesn't get easy soon, then we may see that these inflation numbers are getting generalized into broader inflation and a headline CPI number, and then later to tame this inflation, which may be driven by supply side problems but not by demand inflation. RBI have to do a catch-up act to tame the inflation. But right now, it's too soon to say that. But the direction is that only. Later, the minutes of the MPC meeting was released, where it is pointed out that if inflation is driven by demand, then monetary policy can stabilize it. But however, if the inflation is driven by supply side problems, then the stabilizing role of monetary policy is not there. So the choice is then left to accept the higher inflation for some time. That is what we have been doing till now, or destroy the demand by raising rates. So it's clear that RBI is doing this high inflation as a short-term thing. But still, the market going ahead will price in this possibility that as the growth is getting normalized and inflation is becoming entrenched, this may lead to a situation where the RBI will have to raise rates faster than what is envisaged right now. Recent war crisis between Russia and Ukraine have increased these possibilities by sharp rises in commodity prices like steel, aluminum, nickel, along with crude, and to a lesser extent, even fertilizer and food prices. And all these rise in price have effect on our growth, inflation, and external account metrics. On growth, definitely you can see uncertainties going ahead, as India is still navigating an uneven recovery and countering near-term tailwinds. The economy we know has not fully recovered from pandemic. So this higher inflation which we are seeing right now, if it continues, can squeeze the real disposable incomes of households and weaken the incipient consumption recovery. On inflation side, of course, effect of crude on CPI, we know that $10 increase is going to push up the inflation directly by 0.4%, and we have seen more than $10 per barrel increase right now. But average price during the year, average crude prices during the year needs to be seen to gauge the final effect. But the direction is clear. Food prices in India are not always in sync with global food prices, but there are some items which are tradable commodities within the food basket, which are like vegetable oil, sugar, and rice. So, for example, if these prices can go up within which form a significant part in our CPI basket also. So, crude along with metals, core inflation, and these food items can mean that inflation prices going ahead can be higher than what even market is expecting. Also, we have seen rising farming costs because of the fertilizer, pesticides, diesel prices, and farm equipment have gone up, and this will have a bearing on the coming years fixing of minimum support prices too. On external account, in month of January, we have already seen trade deficit getting widened by around $3.4 billion. So that is largely because of the oil imports, higher core imports. As economy is recovering from the third wave, we saw a good demand of these things. And the recent rise in oil and broader commodities will further add to the import bill in the coming months. There is a predominance of oil imports, in our trade balance, so which is driving the trade deficit higher. And the current ongoing war crisis, will mean this will get even accelerated in coming days. So there will be an effect of through price channel as prices are going up, and there will also be a negative effect possibly because exports too will fall down, because if prices are going up and Indian oil exports can also get hurt. So this will be like a double whammy where the trade deficit can widen. Unless estimates are that a 10% increase would mean that current account deficit will widen by 0.3%. So also there are other items which because of their nature, for example gold, which forms a significant part of our import basket, can see larger demand in coming days because it acts as a hedge, and this kind of scenario people will have this kind of buying in gold, which will also put pressure on trade deficits. Finally, we are in a situation where fiscal pressures are high, and oil prices at pump levels are still aligned towards the last time it was refixed at when the crude was around 85 billion per barrel. but a lot has changed since then, and the next reset will be keenly looked on, because it is expected that fully this may not be getting passed on to the consumers, and some of that will be taken away in form of drop in taxes, but that will have implications on your fiscal position, which is already under pressure. So this all will have effect on yield curve. However, the most prominent factor remains the RBI's role in management of government borrowing program in next year, followed up by build-up of hawkish expectation from FOMC in coming policy, and also other global central banks can act hawkish. We expect RBI to unveil its supportive measures in format of OMOs, OTs, along with continuation of auction management in FY23, because we have a huge supply coming up next year. In this backdrop, we expect investors with having investment horizon of 1 year to 24 months to go for short duration funds and medium duration funds, while investors who have a little longer investment horizon can go for indexation benefits or put monies in the ladder strategy or a roll down strategy. That is it from my side for now. Thank you. Happy investing.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.